Hello and welcome to Trading the Trend. My name is James Boyd. Today's date, February 19th. Behind me is a little snow finally in the state of Utah. So those ski slopes are actually open. So just real quick, we welcome all of you here today. We also got Connie Hill with us in the chat. Let's go ahead and hop right in. We got some questions that have been posted, so let's get to those as soon as possible. Now remember, Connie and myself, all of us coaches, we do post educational content on X as well. Join us there. We do post some announcements, etc., and some educational examples. Also, when we talk about some of the information here, remember that we'll talk about stocks. We will also bring up some options. There's some questions on that. We'll also talk about kind of how those stocks differ than options or vice versa. And also remember, when we talk about options, options carry a high level of risk, not suitable for all investors. Quick reminder, not all of our examples are going to be options, but sometimes when they get brought up, sure. We'll also use the combination of stock and options. So just kind of some context there. Also understand that when we look at the information, it's done for general informational purposes only. And also remember that when we talk about examples, they are just that. They're not individualized recommendations. When we talk about examples, we will do those on the paper money software application. Investing involves risk as well. And also remember when we talk about, there we go, probability analysis. Those are theoretical in nature. Understand that probability changes over time. When we do bring up futures tickers, example like crude oil, Brent oil, just understand that we're just looking at examples of looking at the prices of that, which might relate to oil stocks or gold stocks, etc. We're not trading the futures. We're just looking at the prices. And also remember, when we talk about examples, we'll hop in, we'll talk about kind of what we see in the futures prices. We'll start with crude oil first, work our way down into the indexes, talk about the energy sector, and also kind of some areas that are bucking the trend. In our examples, we'll talk about some bullish and bearish examples. Some of them are post earnings and some are going right into the jaws, the teeth of earnings. And we'll talk about some of the differences between a bullish and a bearish trade. Now, first off, let's kind of start with just real quick. So we got some geopolitical things going on, right? Thea brought up the question about, when there's geopolitical type of events, right? Sometimes you see investors shift back into, let's say, cash. Sometimes that cash, or at least the viewpoint of it, could actually be seen on equities actually going down, perhaps. You could see, let's say, the US dollar rising, some investors shifting from, let's say, currencies that are not as liquid and going back to the US dollar. Now, when we talk about probably the areas that might get pushed down because of that, we probably would say large caps first. You could bring up some correlation studies over different lengths of time and kind of see which ones are kind of more negative than other times. Just briefly, if I was just doing this on the fly, if I click on that little test tube there, I'm going to put correlation on the bottom, okay? Now, remember, when you look at correlation, so we're looking at the chart is going to be the US dollar, right? Correlation here, if we bring this up, correlation to what? Let's start with just over a 10 rolling day period of time compared to the SPX. Let me just kind of show you this. If we take a look at this and I kind of just show this, we got a range here, missing information right there on this ticker. But if I look at that, we're still kind of negative. So if this one's actually going up, there's somewhat of an opposite effect, hence the negative correlation. But if I were to bring this back up and let's just do this for time's sake, we actually say, let's bring up these, let's say the DXY, okay? Well, if I bring up the DJX, excuse me, if I pull this up, which one is more negative? It's going to be the Dow, okay? Now, if we just kind of said, well, remember, if this chart, if the US dollar is actually going up, which index is doing the opposite? I said that large caps. Could we just take a quick look at, let's say, the NASDAQ and kind of see what type of negative correlation there is currently on that? Apply it? No, it's not as much. So I'm going to stick by that answer, Thea. Large caps bearish. Now, if we were kind of looking at, let's say, the DJX to begin with, just super quick, man, and I was looking at this before Thea's question. This class, we don't really have access to like ETF. It's not ETF Friday or ETF Monday. But some investors, based upon what the US dollar is doing with geopolitical events, they might say, look, is there a way to maybe go bearish the larger caps? Try to trade that correlation. By the way, that is trading the trend. You're trading the trend of correlation, which has been a trend. And you're thinking, could that trend continue? So if we were, let's say tomorrow, some investor might say, James, I might maybe as a hedge go bearish, let's say the Dow Jones Industrial, thinking that the US dollar might go up. Now let's actually go into this next piece, right? Crude oil. Now, if we take a look at, let's say crude oil, we're looking at CL, not trading CL, okay? This is light sweet crude. It doesn't matter other types of crude. If we look at this Brent oil, it doesn't matter. So we have some geopolitical external events right now causing some investors to, let's say, go bullish a little bit. Now, for us as stock investors, well, we're not looking to trade this per se. If we don't, you might say, I'm just going to, let's say, look at energy. Now, that's the energy sector in general. There is also an industry group or two underneath the umbrella of the energy sector. Like what? What are the tickers? You have them, right? All right. Now, so when we kind of take a look at this, yes, dollar up, crude up, that is usually geopolitical events. I don't have anything more to say to that besides that's what we're at. We talked about that yesterday a little bit in terms of kind of the price pressure, but yesterday it actually had a nice close and a little follow through here today. Now, if we actually go back to just real quick, let's say the SPX, round this out, a lot of these indexes, okay, let's say example given SPX, they're still in the range, but we have to just be brutally honest. Kind of staying in the bottom of the range so far. If you go to the NASDAQ just real quick, you could actually say, here, look, there's the range. There's the top of the range. Zoom in. We're kind of spending more time in the bottom of the range. The bad thing we would actually say, I mean, if we're just being brutally honest, the one thing you're going to notice is we kind of have lower highs into the floor of support. And if we were kind of in the class tomorrow, some investors might say, James, I'm kind of thinking about maybe just going bearish the indexes. Okay. Now Ben teaches a class on trading index options, etc. Right? It also teaches a class on trading futures on Tuesday mornings. But if you actually take a look at this, there might be some reasons why someone say, look, I want to go try to be protected, go bearish the equity indices. And you could do that in a couple different ways. But if you looked at that, you'd have to say the indexes at best are neutral, at best, right now in the short term. So when I say short term, I'm talking about 2-3 days to 2-3 weeks. Now, super quick, when we look at the front, base materials even kind of coming under pressure. We had a crossover, a negative crossover. You see on the industrials here, the industrials, for example, hit a brand new high. There's a couple stocks in here. Quick reminder, we don't normally bring this up, but it's so obvious you have to, okay? If we said, I don't know what's going up, well, super quick, let's go to Market Watch. No. Yes. Market Watch, visualize. And what I'm going to do is I'm just going to pull this up, going to move this over. So we're going to go to visualize, Market Watch, visualize. We look at the S&P 500. Now, it's the reason why I said it's so obvious is when you look at industrials, there she is. It is yours truly, the big green machine, okay? Now, that big green machine, okay, we know they're not selling go-karts, okay? We know that part. And if we look at this, you're going to see on the left-hand side, we don't normally show this, but you should be aware of it. If I click on indexes, go to public, and you're going to see where it says sector and industries. Okay, these are the S&P 500 sectors and industries. Click on that, and the one that's so obvious, it's right there. Agriculture and farm machinery. Now, why are we not surprised here? Well, because if you've been following industrials at all, Caterpillar's been going up too. Okay, now Deere took over today, but you're going to see that, for example, Cat been driving that area. Now, any other questions there? All right. Now, I want to also, for example, kind of bring up one spot. If we type back in, let's say, $DJT, transports. Are they horrible? I mean, is it tough? I'm not sure if we can say it was like, is it bullish? Sorry, this mouse is kind of playing games today. But when you take a look at this, the transports, not completely bearish. Keep an eye on transports. If they can try to reverse, keep an eye on that, okay? Now, I want to kind of talk about some things that have kind of showed. Let's kind of talk about some of these energy plays, if you will. And what I want to do is let's kind of bring up a bullish example and a bearish example. Now, if we were looking at, let's say, we talked about yesterday, FANG, okay? That is the one that kind of had like a bullish bounce going into, let's say, yesterday, closed there and then gapped. But let's kind of bring up one that, for example, if oil goes up, that might be more sensitive to, let's say, oil prices going up. Now, could you put in the column heading, okay, on the market watch? Could you make a list of energy stocks? Yes. Could you, for example, put a correlation column and just put, let's say, crude oil in there and see which one has a high correlation? If oil goes up, which one of these stocks goes up historically? Could that happen again? Yes. One of the stocks that, if oil goes up might be Halliburton, okay? If we go back to, let's say, just real quick, the trade tab. Now, let's imagine the investor says here in this case, hey, look, I think the price of oil could go up, and I'm going to try to trade, in this case, a bullish trade. Now, let's imagine the investor says, look, I want to get in, but I'm a little nervous, right? Well, the geopolitical thing is there's reasons to be nervous, okay? Now, those reasons might not fully materialize. How we think it might lay out might not completely happen that way. That's the way it happens a lot of time. But what I'm going to do is I'm going to go to, let's say, the market watch, the trade tab. Click on the trade tab. I'm going to type in HAL, okay? Now, in this case, I just want to kind of double check something, okay? HAL's a $35 stock, okay? So if you said, James, I don't trade oil, okay? Well, you might try to trade something that's trying to track the price of oil, okay? Now, what I'm going to do is if I right-click on the ask price and go buy custom, and I'm going to go, in this case, with stop, okay? Now, if I did that, this is just going to bring up a stock order, okay? To buy in green, red to sell. Now, in this case, if I went back to this and said, okay, what do we got? Let's bring up HAL. If I brought up HAL, let's go to that first chart, said, where do we see that support level? That support level is going to be right around the area of, let's say, high 32. It's right around the area of, let's say, 32.73. So if I type in 32.73, less 3%, and I'm saying if we do stock only, okay, 31.74. So if I click on this, 31.74. Now, you can have high historical correlation. That doesn't mean it's going to materialize. What happened in the past is not going to be the future. I try to tell my wife that. She doesn't like that answer. But the biggest actually, you get it? Okay, good. How many of you gals get it? That's important. Or vice versa. I tell that to my husband. Past kid doesn't mean, okay, you know what happens. Now, if you take a look at this, 31.74, okay? So we have a forecasted risk. Could we actually do 100 shares of stock? Yeah, I think we could. That's not going to be over position size. So trade number one, we're not trading crude oil itself, okay? We're not trading crude oil itself. We're trading something that's trying to have a correlation. If we said, could I bring that up just to kind of visually show that again? How do we put that on? Go back to the test tube, okay? And now remember, that's to the S&P 500. I don't want the S&P 500. I want something in this case like crude oil, CL, okay? It could be an ETF. It could be an index. It could be a futures ticker, etc. Now, if I click on that and say apply and okay, remember, the correlation is only going to go from +1 to -1. So anything that, for example, in this case is closer to 1, okay, that'd be better, okay? You do not want to see something that has negative correlation here. Most of the time, it doesn't have negative correlation. When it's below 0, it doesn't stay there for very long. So if HAL is actually going up, you're going to see that that crude oil, it's not 1. It's spending a bulk of the time right around 0.7. Okay? Now, the comment came in, well, maybe you do like a covered call, right? Maybe you buy a put. Well, I won't speak that too long, but if we kind of went to, let's say, a delta of, let's say, 30, which we've talked about, we talked about the strategies of married puts. You remember that? Married put just means you buy the stock and then you buy the put at the same time, okay? Now, we've done this before. Let's say this is my phone. It's not. But let's say this is my phone. I buy the phone. I'm concerned that I might drop it, okay? So then you buy the phone and you buy protection on the phone. But here it's not a phone. Here it's shares. So then with any protection, it's not indefinite, right? And so there's a cost for the protection. If we actually come in and say, well, maybe I'll buy the put. Is that a good idea? Is that a good idea? Well, we actually gave a solid answer, which is we might consider buying the puts if maybe that implied volatility was probably 25 or less. We don't have 25 or less. 43. I'm not liking the put right here. Okay. Now, could the other investor do it? Sure. But if someone's trading a rule set, it's not meeting that criteria. When we actually double check and say, okay, look, if we paid in this case $1.21 for that put, I'm just answering the question. We paid $1.21 for the put. Okay. And what's the stock price here? Well, that stock price, if we take a look at this, is about $35. Okay. $35. And if we take a look at this, this mouse is killing me today. $35. Okay. I'm really doubting that. That looks like 3% to me. $1.21 divided by 35, that's 3.5%. We talked about doing the example if we could buy the puts for less than 2% of the current stock price. We're nowhere near that. If we're trading a sample plan, that's probably not what we're looking at. Could someone maybe say, look, the volatility is high? Could they try to sell a call? Oh, now we're thinking, okay? So I like where you're going with that, but I just want to answer that first question. Why not buy the put too? It's too expensive. The higher you buy the put, the higher the stock has to go to break even, which becomes less probable. That does not mean it can't happen, can't get to break even, but the odds are not very great. So that's why the investor might say, if I'm going to do anything with an option, the investor says, I might just do a buy right covered call. Okay. I like how you're going. Now we're thinking. Confirm and send. So trade number 1, just buying shares of stock with a stop. So this is saying if we buy the shares at 35.02 or less, sell the shares at 31.74. Okay. Now that's a key. That's a trigger to sell. Doesn't say it's going to exactly sell at that price. So just note that. Send the order. There it is. Now, and yeah, PC mouses, they're just, man, tough today. Now, comment came in just real quick. Let's answer some other questions. When we look at crude oil, I mean, probably when people talk about crude oil, I mean, if we're looking at crude oil in general, it's really going to be CL, okay? Some people might, for example, bring up QM, okay? I'm not going to get into the differences there. You can look it up yourself. Just it's not for this class. We're just talking about what's a ticker you can look at. QM might be really the second one. Okay. Now, both of those though are the same light sweet crude. Okay. Now, other questions. Okay. No, that wasn't a phone. Now, okay. Now, what I want to do is I want to kind of take a look at a company. Let's go back to NVIDIA for just a second, okay? Now, NVIDIA next week, let's get correlation off. Let's pull that off. Take that off. Had a nice, by the way, some people really like correlation, okay? I'm not going to look at the camera because I don't want you to I don't want to have you think that I like correlation, okay? You can't see my eyes. Now, I want to go back to this example for just a moment on NVIDIA. Now, NVIDIA has earnings, okay? Now, earnings is tough because you don't necessarily know the reaction of the investors. It's not just the earnings, which means did they match historical? Then you actually have, does the company change its guidance? That's the second thing. And the third thing is, how do investors react to that? Are there people that are planning to buy after the earnings, net positive? Are they planning to sell? All the above. Now, let's say the investor says, look, I like to actually do, let's say, selling strategies when the implied volatility is high. Why? Well, if the implied volatility is high, the expected movement, you're going to now notice that, let's say if we said, well, what is this expected movement? Watch that cursor right there. It's about 55%. How many times during the year do you get to actually buy or sell something when the IV is at 55? It's not very often. Now think of the implied volatility like a balloon, okay? And it doesn't matter if the earnings are good or bad afterwards, the news is out, right? Now what I'm going to do is I'm going to go to the trade tab for just a second. And we're going to type in NVDA. Now the current position on that, we need to speak on this, and we're going to do this for two reasons. Number one is, what type of strategy is this below? Well, that's a 180 down here. Sold that, the 180 put, which has 1 day remaining. 1 day as in tomorrow's expiration. That option was sold for, down here at the bottom, okay, 455. It's at 32 cents. Yeah, I want to get that last 32 cents. Well, if you got the 32 cents, but then you lose the 4 cents on the backside, what you can really make is the net of those two. It's about another 28 cents. Some investors might say, I'm not going to risk it, okay? We're not that far away from the short strike price. So what we're going to do in this case is we're going to right-click on this. This is the short put vertical. Right-click, create closing order, and we're going to buy it back. So we're going to take that position down, and then what we're going to try to do is set up another one. I cannot stress this enough. A lot of times when people do, let's say, earnings trades, there were stock trades or short stock trades, like AMAT from last week. That is extremely risky, okay? Because whether you buy the shares or you sell the shares, your short stock, you have the highest delta, okay? So if on some of these options, at least the ones we're talking about, we can actually have a defined risk, and that does not mean the stock goes to zero, okay? So some people might like that. Now what I'm going to do is confirm and send. Note the commission there to get out of that. Send the order. Now, what we're going to do is we're going to go down to the March, 20 March, okay? Now, what I'm going to do is with higher implied volatility, now, obviously, if we did the ones, let's say, next week, or actually, excuse me, 27 Feb, that is probably right in the week of the earnings, because that's where the implied volatility is the highest. Well, I mean, it's not that bad. I mean, it's still 54 if we look at the March. And what I'm going to do in this case is we're going to go down to the kind of the lower end of the range of delta. So that delta, again, is telling us the likelihood as of right now, the stock being 1 penny below the strike. Also, the change in the stock price over the change in the option price, okay? Think of it as a translation, approximately. Now, what I'm going to do is I'm going to keep the $10 wide strike. So trade number two, we're going to sell the 175. Now, how do I know which strike to sell? Well, could look to sell any of them. Option number one, what people might do is, where do they think the stock could stay above? Okay. They might look on the chart and say, look at the technicals. They might say, where do I mind, or where do I don't mind in owning the shares of the stock? That might be another answer. You might say, third answer would be, I'm looking at it in terms of strictly probability. If I say I want my odds higher, They might do something like a 20 delta, okay? Or a 20 delta, which is a 80% chance the stock could be above the strike as of right now, 20% chance below. Now, if we look at sell vertical, I'm going to widen this out to, let's say, the 165. Because if we did, we're probably going to really be doing 2 contracts. Now, if you notice this, you get a $2.50 credit. The max loss, $7.50. $10 wide spread, $2.50 credit, confirm send. There it is. Note that commission. Now, James, could we have rolled that order? Yeah, we could have. Okay. Now, what I'm going to do is I'm going to go ahead and send the order. Now, we got out of our first position, and then we entered the second one. So if we knew, let's say if we did this quite a few times, we could have just rolled the order all at once, but I kind of broke it down so we could see it. Now, I want to go down to just real quick, a couple things that are getting some movement here. So number one, if we take a look at, let's say, a couple of these stocks, GE, okay, is getting a little push, okay? Now, it's not just GE by itself. It's GE. Am I missing anything? Am I missing any other stock related to GE? Now, we could say GEHC, okay? Oh, you don't see it there. What about GEV? Yeah, not too bad, right? Bigger one. Am I missing any? I just want to make sure. I think it was actually just GE in general that was actually getting a little push. Now, if we take a look at this, I want you to kind of notice here on GE itself. Now, if we take a look at GE, kind of has like your classic like V pattern, if you will. Okay? Little run, push down, run back to the upside. Now, here's a short-term flag. These, when we say flags, they do not have to be something where they went down for a week or two. Okay? Many technicians prefer, no, please do not go down that long. Give me some momentum, the momentum trader says. And we actually see it went down for a day and then a pop again to the upside. Okay. Now, let's imagine the investor says, yeah, this all looks great, but wonder if it goes down. Well, let's go back to the trade tab for just a second and actually let's look and see what its implied volatility is. Well, now remember, if we have an environment where the VIX is higher, now in my mind, I think of like the VIX like the waves in the market. Okay? Now, if you live, let's say, I don't know, live next to a river, okay, a lake, the ocean, the higher up this is, the more choppy the water conditions are going to be. Okay? Now, that might influence the strategy that you pick. Sure. Okay? Now, it also is going to influence maybe the spreads on the options, the spreads on the stock, the liquidity, which changes on the stock and the options. Now, if we pull up GE for just a second, you're going to notice that right there, when we talk about, let's say, the spreads, if we look at the call side first, 65 cents wider there, and you got about 60 cents over here. Okay? What about the spread of the stock? It's about 20 cents or so. Now, if we have choppier conditions, could the investor just chop the position size? Sure. Could they try to do dollar cost averaging? Sure, that's an option. Okay? They can do whatever they want. But what I'm going to do is I'm not going to choose the option here. Those are 60 cents wide, 65. Okay? We're going to right click on the ask, buy custom, with stop. Now, here's the deal. If we take a look at this before we look at a bearish example, I'm going to go back to kind of look and see what do we got in terms of like that recent support area. Well, that recent support area, if I zoom in on that, is going to be right around, I mean, if we kind of look at where the moving average is, it's probably right around 325. If I give a little bit more breathing room, probably right around 321. If we take 321 less 2%, okay, Well, it's going to be 314.58. So if I type in 314.58, there it is, stop day GTC. So if you said, James, I trade stocks and options, sometimes you don't always have the option to do the options per se if you're trying to adhere to strict liquidity standards. Whether you look at the bid-ask spread like we did, or the volume and or open interest on the options. We didn't see the spread was that great, okay, or it wasn't narrow to show that there's that current liquidity. So we chose the stop. Now, remember, if I did this and I say, look, I'm going to come in, let's say we did a half position. Now, I think what happens in our mind is we always think that every time I get in, I got to take a full position. Who says that? No one says that. Well, that's what I've done in the past. Well, why do we have to do that in the current or in the future? We don't, okay? We're going to try to build a position. Now, we have a rule set called you show trend, the paper money account shows more money. Now, I kind of like to think about this with raising my kids, okay? Just because we share the same last name, that's great, and I love you to death. But you show me that you're doing more, we can talk. Okay? Now, here's the thing. 332.78, that's that price or less to get in, not higher. If it fails, if it buys, then the stop actually is there, right? And it's saying sell if we go to that price or less, okay? Confirm send. Now, I want to go back to just real quick, and I'll fix that. When we also go back to another question, there was a question that kind of was brought up in terms of, let's say, bullish and or bearish trades. I want to kind of show you some things where you said, wow, some of these trends don't look that good. Well, let me give you an example, okay? Zscaler. Man, now, by the way, some of these software companies, let's just say let's use the tickers Microsoft, right? Zscaler. Another software one would be, let's say, not Zscaler software, but it's related to. Salesforce, struggle to say the least, okay? Microsoft, struggle to say the least. Now, again, if we're just being brutally honest, we got to be a little concerned about the hockey stick-like pattern where you drop down in price and there's not much of a bounce off the low. Okay, the positive is it hasn't they're knocking the price higher. I mean, if they're knocking it higher, someone's on the other side selling it, okay? So I want to kind of just take a look at a couple of these and do a bearish example. This was a question that I want to actually kind of grab. Now, this works. So notice a couple of these payroll type places, whether it's Workday, okay, PAYX, yes. That doesn't look very bullish, right? So you're kind of just seeing a lot of these where there's pretty consistent drop, okay? And what you're now going to notice is, so we mentioned ZS, Salesforce, CRM, Microsoft, Workday. I'm even going to include Adobe. Boo! And if you look at, let's say, Adobe, that has not been very nice either. I mean, just brutal, okay? I mean, it just drops down and just very anemic up moves at all. Not that many green candles before sellers come back in and smash it down again, meaning they actually make a lower low. So why does it kind of do that? Well, obviously, sellers overwhelm the buyers. It actually pushes down the price. Then when you actually come back up, why does it do that? Well, if people are trying to sell more, they're trying to get a little bit higher price to sell more. I mean, if you had a lot of shares, you try to let the price come back up before you try to sell some more as well. And that's what these institutional investors do. They don't just have 50 shares. They have 500,000 shares. They have 5 million shares. And they don't want to cream the price on themselves. Okay? Now, what I'm going to do is I'm going to go back to just real quick. I'm going to use the example given of Zscaler. Now, in this example, I want to choose something that has earnings. Now, last week we showed an example of AMAT. We did a short stock example, which is the riskiest thing ever because the stock could go to infinity. Some people don't like that. Just in terms of like, is that a great idea to actually have unlimited risk? I mean, some people just say, look, that's exactly what I want. Okay, not that many people. I mean, who might say that when you logically think that? Do you want, maybe not, okay? Are there some? We could probably find a couple, okay? But the big thing is many people don't like that unlimited risk. So let's kind of show this from our perspective. We're going to do a bearish trade. Now, when we actually did a long synthetic was buying the call, selling the put. Well, that is a bullish example. Now, I got to look and see if we can do this currently. Now, if we did this, buying the call, buying the call, that's a single option order, okay? Selling the put, that is a single option order. But if you talk about multi-legged or a combination, right? Well, if you put them together, you don't have one, you got two. And those are two bullish option trades that creates a unique delta, gamma, theta, vega scenario, okay? Now, if we said, well, I actually don't want to do this as in terms of a bearish trade, bullish trade, I want to do a bearish, well, we could kind of flip this. If I flip this and actually say, look, I want to sell the call. Now, wait, if we buy the call, want the stock to go up. If I sell the call, that must mean the investor thinks the price could go down. We know that if we sell the put, we want the stock to go up. If we buy the put, that must mean we want the stock to go down. Now, let me just show you this real quick, and we're going to decide which one we're going to pick based upon liquidity. If I analyze this trade, it's going to be the risk profile that looks very similar to shorting stock. Now, most of the time, we see diagonal lines from lower left to the upper right. Not on this one, because on the bottom, the x-axis, that's the stock price, and the y-axis, that is the profit loss diagram. On the left-hand side, the profit or loss given the stock goes from right to left. Now, if we go from right to left, that means the stock goes down. Stock goes down, we go up higher on the profitability. Now, the con about this is, wonder if the stock actually goes up. Well, if that stock goes up, the bad part of that trade, if you sell a call, if that stock goes up to, let's say, $600, $700, there's a huge loss. Okay? Well, how do we cap that? Now, I'm not going to use the example, so we're going to use this, but we don't like this short call by itself. That's a naked call. Okay? Now, what the investor could do is they could say, let me go to just real quick. I'm going to look at one, see which one's a little bit more liquid. Now, why did I change? I was just talking about the strategy first. When we looked at Z-scalar, the spread, 40 cents on the out of the money. I'm just double checking 80 cents. These are wide. Okay, I don't think we need to expound upon it. You could see it. If I went to, let's say, CRM and said, what is this? We see something tighter. Okay, 10 cents, 25 cents. So that looks tighter. What about something like Adobe? How tight is that? Kind of 25 cents, 70 cents, 35 cents. So probably would say CRM first, Adobe second, paychecks? No. Okay, wider than that for the most part, and not as many strikes. So if I went back to, let's say, workday, now what we're going to do is if we did this on workday and said, look, what I want to do is I want to do a short call vertical. Now the short call vertical, you get a credit, and there's a cap loss. And this is very important when we understand this. When we see this diagram, what I'm going to do is I'm going to put that trade in first. I'm going to right click on 150. The strike that you sell on the call side is where you think the stock could stay below. So now if I go sell, vertical, okay, there's your classic vertical. Okay. Now I need everyone to kind of answer this question. Okay. How many of you have said to yourself, I would like to learn bearish, but I've never practiced before? Well, welcome to your first bearish trade. Now, are there some times where a stock goes bearish? You better believe it. Are there some times where the market goes bearish? Yeah, absolutely. Okay. Now, the thing about bearish is sometimes it doesn't always last forever, but there's sometimes where it can absolutely go down. Okay. Meaning there's times when it does. Now, what I'm going to do is notice what we're going to do on this next step. We're going to go single order. And what we're going to do is first triggers sequence. Meaning first get into that short call vertical and then add the long put. Now, what side of the trade could make more money? Well, it's a simple answer because we can visually see on the chart. If we were right on this short call spread, we could make $1.45 cap. But if we bought the put, let's say out of the money with a delta 30 to 40, example given, let's say the 135, click on that. Well, the stock theoretically could go to zero. Now that, theoretically, come on, okay? Yeah, theoretically. But, so yeah, the put can make more, but it has a low probability assumption that the stock can go to zero. Okay, so you just got to put a little asterisk on that. Seems like a positive, but that's a low probability scenario. This right here, if we now bring this up, pull it up for our first bearish trade. Now, by the way, this is a way to really learn bearish trades while defining the risk. The short call vertical, and I'll show you this individually. The short call vertical by itself, you're going to see that max loss. Stock goes to the right or up, max loss built in. Con about that vertical, there's a max gain. Okay? Now, many investors say, geez, I don't want to just be right and only get $145. I know how you feel. There's not that many people that really teach about short synthetics. But if you said, James, I like to be bearish stock, there's some similarities to this, a short synthetic. It's altered because it's doing a short call vertical plus a long put to cap the loss. Now what you're now going to notice is if we looked at the long put by itself, it actually has the unlimited upside to a point, meaning the stock can only go zero. So you could say it's unlimited until the stock goes to zero. And the max loss is just built in, whatever the premium is. If you combine those two together, welcome to the world of a short synthetic, also known as a combo. Okay, combination of strategies. And now what you're going to see in this case is it has a max loss with both of them. Okay, and you're going to see that unlimited upside cap though when the stock or if the stock went to zero. Okay, so this is a way to really kind of learn bearish. And it's nice about this is you're learning it from the perspective of something that's trying to benefit from time decay and probability, and this really being the kind of the more pointed instrument. If you get that direction right to the downside, that could appreciate in value, maybe. And also if the volatility rises, that might inflate the premium to make that position more profitable to try to sell. That could also go the reverse, right? We're going to go ahead and say confirm send. Now the question was, do you have a class where you just went over this? I'm not aware of like a class where we just did a class on short synthetics by themselves. Not at least right now, but I'll double check, but I don't think offhand. But I wanted to address this because there are some stocks that from a trend perspective, they are not bullish, okay? Now this class is trading the trend. Trading the trend bullishly, we talk about each week, but sometimes trading the trend is not bullish strategies, they're bearish strategies. So if someone was brand new getting started in learning bearish strategies, probably would start off with, example given, it's an example, short call vertical, long put vertical, long put maybe, but if you said I'll go short call vertical, long put vertical, and short synthetic. those are probably three strategies that some investors say, if I'm going to practice, I'm going to practice in those three. Okay. Now, why did you kind of just push away the long put? Well, the long put, we're going to use that in the short synthetic. So we can learn that with the short synthetic. So let's focus on three strategies for a bearish trade. When we say bearish trade, we're talking about any strategy that it has a negative delta, meaning if the stock goes down, it could benefit. Okay. Now, what we're going to do is click on that. I got to wrap this up, but want to kind of today I tried to answer a number of your questions here today. We did a number of examples. We did the example of NVDA. We also did GE. We also actually want to keep our eye on, let's say, crude oil, especially over this weekend. We did the example of Halliburton, and the bearish example, we did the example of Workday. Now, remember, coming up next, we got Brad Crowther teaching on short verticals. I want to thank you for your comments and questions. I tried to answer as many questions as I could here today. And thanks to Connie and to all of you. I'll be back on tomorrow morning with Kevin Horner as we talk about ETFs, bright and early, live only. So join us there. Thanks again to all of you and again to Connie. With that said, this has been the class on Trading the Trend. Take care. Bye-bye.